Welcome to today's webinar on the Deep Tech Hardware Napkin 2025 and what it actually takes to raise money from VCs as a hardware founder. Super excited to have you all also today on the webinar. I already posted the link in the chat, so if you haven't downloaded yet, really do so. And there are more insights while we also will dive into it more today during the webinar. My name is Lena Späth. I'm head of platform at First Momentum. We, First Momentum, are a German-based deep tech investor investing basically in the boldest bets when it comes to deep tech and industrial tech in Europe. And as part of this, we also try to really shed more light onto what it takes to raise as a hardware or deep tech founder. Before we start, and I also, Max will perhaps say a few sentences about himself, I quickly wanted to check who is actually in the room. So would love to hear, who are you? Are you a founder? Are you a VC? Are you perhaps an LP? Are you something else? That would be really awesome. So then we can also tailor with our discussion towards this. You will have more time after kind of a quick introduction and also a few questions from my side to really just ask any question to Max regarding the Deep Tech Hardware Napkin. But I see we're already heavy on founders. That is always amazing. So great place to be and really ask also the questions that you need to be answered, perhaps also to raise your own round. So cool. I see. Yeah, almost 50% of us here in the rooms are founders. So then I would say, to kick things off, Max, do you perhaps want to say a few sentences about yourself, who you are?
Sure. Thanks, Lena. Super happy to have the session here with you today. So I'm Max. I don't have the typical VC business background. I'm a physicist, have a PhD in physics, did 5 years of research in the field of nano optics, basically tried to control artificial molecular machines with nano antennas. It was a pretty cool project, didn't really work, but was still a lot of fun to do. I then had some other positions, joined First Momentum by the end of 2022, and then kind of co-build up our deep tech segment here, involved in most of the deep tech investments. I do a lot of compute, semiconductors, for example, quantum diamonds, roofline, but also basically everything else that excites me in aerospace, energy, industrial tech, and so on.
Yeah, I think you're actually really an example of First Momentum. We're not a typical VC fund in the sense that a lot of our team members actually have an engineering or also a scientific background. So that's why we really like also problems that get solved for basically engineering and tech work. Yeah, perhaps to kick things off, Max, how did you actually come up with the idea of starting the Deep Tech Napkin?
Yeah, I think that was already last year. I mean, now we're talking about the second version of our Deep Tech Napkin. The first one we published around the same time last year. And the idea was basically that we got a lot of questions from both, like mainly founders, but also some VCs, like what is actually needed to raise a round, let's say a pre-seed round, a seed round, a Series A, like how does the team have to look like? What is the commercial traction, tech traction? How big are the rounds? What are the valuations? Like how does it work for deep tech hardware companies? Because they are so different from software companies. And actually in SaaS, you have this, some people might know it, it's relatively famous, the SaaS napkin published by Point9. That was kind of like the inspiration for us because they did the same for SaaS. They asked a bunch of VCs and collected data points for round sizes. And then they kind of created this framework of what do you need as a SaaS company to raise a round in, 2022, 2023, whatever. And so they did this. They called it the SaaS napkin because everything was summarized on one page. And we really liked the idea. And it was, from that, it was very clear that there's a specific playbook. If you're a SaaS company, you have to, hit 1 million ARR to raise a Series A round or something like this. And we were kind of missing that playbook for deep tech hardware because it's so different. So we already assumed that the playbook will look very, very different, but there was no standardized way of saying, what a company needs. Obviously, deep tech hardware is also a very big space. So there are industrial companies, energy companies, there are quantum computing companies, space companies, and they all have very different pathways to success. But we nevertheless wanted to kind of try to find a common ground among these deep tech hardware companies. And that's basically how it all started.
Yeah. And how did you mentioned this, like we had the last version already from 2024, like how did you see also the market kind of evolving from last year to this year? And yeah, what were perhaps also the biggest changes you see?
I think, like, I mean, overall, there are changes in numbers. There are not so much changes in what you need as a team or what you need in terms of commercial traction, tech traction. I think there are some subtle changes, but I think the main story is the same from last year to this year. And in that sense, there are changes in the numbers. Like pre-seed rounds got a little bit smaller compared to last year. Seed rounds got, I would say, much larger. Series A is pretty much the same, maybe a bit smaller. And what I really liked is that last time we struggled a lot collecting Series B data points. It was just super hard to find Series B hardware companies in Europe that raised a round last year or like the year before. And we had like, I don't know, 5, 6 data points in Series B. And this year it was much, much easier for us to collect these kind of later rounds. We had much more contributions at Series B, which kind of points towards a more maturing ecosystem, right? We have much more, I would say, later stage deep tech hardware companies that are on a successful track than last time. So that was very encouraging. At the same time, I think team-wise, the biggest thing that stood out this year is that probably teams at early stages, like let's say pre-seed, seed, they got even a little bit more technical than they were last time. So we're looking at something like, I think for pre-seed, 90% of the companies have, PhDs on the team. So that kind of points in the direction that most of the companies are coming from an academic background, spin-off from universities. We also don't see many serial founders still. That is similar to last year. So I would say we have a lot of like first-time founders with an academic background that spin out their technology from university, which is, I would say, quite a difference to, for example, US, where the ecosystem is much more mature. You have much more serial founders because you have more successful deep tech hardware companies who exit, and then the founders kind of start something again, and so you have this kind of experienced founders that start companies in deep tech. That is something Europe doesn't have yet. So we're still running with a lot of like first time founders, which is cool, but at the same time we are seeing now much more Series B companies, and so my hypothesis would be that if we do this a few more times and over the next few years, we will then at some point also see much more, serial founders starting new deep tech companies because the ecosystem is maturing in a way.
Yeah, that would have actually been my question. Like, how long do you think it will take until we will see kind of the profile also change, that in pre-seed now we see the serial founders?
Yeah, good question. I mean, don't know. I mean, it's like, I think most founders who have like successful deep tech companies, they will not start something immediately again after exiting their first company. They might enjoy some time off. No, but I think like it's probably a matter of, I don't know, if I had to make a wild guess, like 5, 6, 7 years or so.
Yeah. I mean, we are also a pre-seed investor, and like, I mean, for the pre-seed stage, we saw this year also that actually industry experience became a bit even more common. What do you attribute this to?
Yeah, I mean, it's a good question. I think it was also a little bit surprising because last year the numbers on like industrial experience were quite low. I think when you ask deep tech founders what they are looking for, like I think everybody will be like, okay, yeah, we want technical excellence, right? So we want to have teams that build strong technology and are among the top few percent of people in the world who can build something like this. But at the same time, obviously, you want to invest in companies that have a high level of commercial savviness, intelligence, whatever. Um, and that is like if you're betting on first-time academic founders, this commercial mindset is I don't want to say like these type of founders, they don't have it because a lot of them have, but it's something that not all the teams have. So and then it's like, okay, how can we get commercial intelligence, savviness into these founding teams? And I think like one way would be having, commercial co-founders, pairing the excellent academic founders with excellent commercial co-founders. And we see that happening. So that does happen. I think the share of companies that have this setup is still relatively low, which tells me that investors are probably still valuing the tech expertise a bit more. At the same time, another way of getting this kind of commercial thinking into the company could be industrial experience. And that's another element that we saw much more emphasized at this time.
Yeah. I mean, we also want really to give a lot of time to questions. So just two questions here from my side. How do you recommend, or what do you recommend to founders? How should they actually read the Deep Tech Napkin when they think about building their company and raising the next fundraising round?
I mean, so the way we kind of set it up is to have the most relevant information on the napkin on one page, basically, right? Like I think a lot of people are always interested in valuation and round sizes. That is obviously an interesting question, but it's not like the most important essence of the napkin. I think it's much more interesting how the team should look like, commercial traction, tech traction. If you're a pre-seed company, obviously the pre-seed column in the napkin is more relevant to you. But I think most deep tech companies, they are on a kind of like mission towards a goal that lies into the future, several years into the future. And so you're going to de-risk your company step by step. Let's say you want to build a fusion plant, right? You can't build a fusion plant right away. You have to step by step de-risk your project and kind of, build, I don't know, smaller pilots and kind of scale up until you can build a real fusion plant. And so I think most deep tech hardware companies are on this kind of trajectory where they have a starting point, very stage, lab demonstrator, for example, and then they want to go all the way to a real working technology facility, whatever. And then they need to step by step de-risk that. And I think it makes sense, even if you're an early stage founder, to kind of understand what do I need to have to raise even the next round or the round after that. Kind of be aware that although you want to raise a pre-seed round, and that might be the most important column for you, it's always good to know what comes after that. Like how could I structure my milestones actually on that way? Because even at early stages, if you're pitching a fusion company, investors will ask, okay, how not they will not just ask like, okay, how does the next 2 years look like, but how do the next 5, 6, 7, 8, 9, 10 years look like? And so you should have kind of like at least an idea of that as well.
Yeah. And I mean, we aggregated basically data from more than 20 VCs across Europe. I mean, all of this is anonymous, like the data, but would you say there is a lot of common ground for each round on what are the top 3 points? Or does it differ from VC to VC what they look for?
You mean the type of boxes that a company needs to check?
Yeah, exactly.
I think that there's a common ground. I think that's what we see in the napkin. I think that, but there are nuances to it, right? One example could be commercial traction. I think that is it's very difficult to generalize because different deep tech areas are very different, right? Like a fusion company is not making any revenue at all for most of its time. Robotic companies, for example, need to make revenue relatively quickly, or at least they need to have some type of, pilot traction relatively quickly. So there's kind of a big range depending on which area you're in as a company. At the same time, I think some investors, they look more strongly at technical milestones that you hit. Other investors are maybe like, yeah, how long is the pathway to getting offtake agreements, or how long does it take to sign, the first customer? And they might put more effort, like more emphasis on that. So I think there's a kind of a little bit of there's common ground, but at the same time, there's a little bit of spectrum also depending on the case. Um, so if I had to say, I would say on the tech side, most investors, I would say, are aligned what they want to see. On the commercial side, I think there's a bit of a spectrum there.
Yeah. Cool. I would say then let's soon also switch over to questions. For the ones that put it into to the chat, please also there should be a Q&A button. Put your questions there. You have the chance now. And then I would ask really my final question, which is like, because this is something we can't also see from the napkin or also the report, but you can probably see that from the aggregated round sizes. What are VCs actually super hyped about? Like what are the topics that you saw also when aggregating basically the data? Because we have this industry part as well. So
should we answer that now? Or
yeah,
because
I'd answer it now that people can put their questions into the Q&A.
yeah. I think we did see a lot of industrial tech. I think that is everything: robotics, automation, also like energy transformation is still a big topic. We saw a lot of um, semiconductor companies, or let's say, semiconductor, microelectronics, photonics. We kind of like bucketed it as one. I think there's a lot of movement in that space, but also pretty much aligns with what we are seeing. We also, for the first time, included defense. We didn't have defense as a separate entity last time uh, because it was just not so relevant in 2022, 23. Obviously, that has changed very much. So we do see a lot of that as well in the napkin. I think we kind of see most of it in industrial tech, energy, and kind of the semiconductor, photonics, microelectronics space, and then have several smaller areas.
Okay, cool. Then, kicking things off in the Q&A, Marek from Vigo Ventures is asking, do you see more serial founders in the US in hardware lead companies?
I mean, it's kind of a gut feeling because we haven't done we didn't collect any US data, but so my feeling would be yes. So just, as I said, it's a gut feeling. So my feeling is that especially in the semiconductor space, you have much more people founding companies in the US, and in Europe that is still not the case. As I said before, my hypothesis is that this changes as the ecosystem matures, but that's going to be a longer process.
Great. And just please, everyone, don't use the chat. Please use the Q&A. That's way easier. And we can also answer your question later on if we don't have the time. Do we value deep tech startups at pre-seed stage? Not
Yeah,
sure.
I think that question is probably about the valuation itself, if I understood it correctly. So actually, we don't really do that because nobody can assess the value of IP or whatever you have sitting in the lab. So what is usually done is you raise an X amount of money, and then you apply a usual founder dilution of 20 to 30%, and that kind of brings you to your valuation. So meaning you will give away 20 to 30% of equity in your company to the investors. And if you have, and then it's always like, so that's kind of the typical range, 20 to 30%. And then depending on your traction and how amazing you are and how much demand and how much FOMO you generate in the fundraising process, then you might be closer to the 20 or closer to the 30%. But it's kind of like the rule of thumb range.
Do we really need IP for early stage deep tech? Will VCs look into that?
Yeah, that's a good question. I think that is, I said earlier that tech-wise, most VCs are probably aligned, with the exception of this one. I think there are quite big differences from VC to VC on that side. If you ask me, I think I have a pretty clear stance that IP is generally overrated. Like patents are generally overrated, mainly because I think that there are very few companies who win 10 years down the road because of a foundational patent they have developed at university times. It's usually that you have a good IP foundation, and then you kind of continuously innovate and create new IP and new patents on the way that kind of enable the product 10 years later. So I think the initial kind of university IP is usually overrated, in my opinion. Um, I think in most cases, when we look at companies, it's almost always more of a founder bet than an IP bet. So we bet on founders and their like technical excellence to continuously innovate and create new IP. Existing IP is of course a good proxy for your ability as a technical founder to create, new IP and something like this. So that could be a validation point, but it's not like we invest because you have a great patent, but we invest because you were able to make that great pattern. I think obviously that is true for pre-seed stage, at least for me. That might change quite a lot when later stage investors look at your company because they might consider IP as some sort of downside protection. Especially, I would say at Series A, Series B, that becomes much more relevant. So, but at early stages, I think it's typically overrated. But there might be VCs who think about this very differently.
And there's, of course, also the part of public grants, and just referencing the president of the board of the EIC last year, who was at our spin-off summit. Basically, I mean, investors also want to see that you can also acquire free money. And like basically for the EIC, his quote was like, minimum I want to see 3 patents. So yeah, it can be that not for the VCs, but for other institutions you need them. So yeah, what would you change in how incubators, accelerators prepare deep tech startups for investment?
How incubators do it. So I think I'm a bit biased because I think most incubation programs, they create companies, they take a large ownership in the company, which typically is an issue for us as pre-seed investors, because we look at, okay, we would try to get in as early as possible. Companies usually have 100% of their ownership. If there's an accelerator on board that has taken 20-25% of ownership, that's typically something that is very unusual for us as pre-seed investors. So for us, it's always like, okay, difficult to engage with these type of startups. That might be very different for a seed Series A investor. They might think very differently about it. That's why I said I'm biased. I'm a bit skeptical about these large ownerships. We're actually currently having our own first venture building adventure, building up Tellura, which is a similar story. And there we specifically try to not take too much ownership, to kind of have a cap table that is okay for most other VC investors that come in the next stage. Um, so saying, for example, giving away 15% to your accelerator is better than giving away 25%, to put some numbers there. I think the other thing, so that's one thing that VC investors always look at, okay, how much equity do they have? The other thing is, what type of teams do we see here? Because a lot of times accelerators or incubators, they kind of do this team formation where they put in 2 great individual people, a very technical person, a very commercial person, and they kind of match them. And then these people, they don't know each other for a very long time. And when they go out fundraise, every VC is asking, okay, is there a team risk? Because these guys have never seen each other before, or just know each other for 3-4 months. I think that is something that's like we're having a similar experience now with our venture builder adventure. And so for us, the way we kind of did it is really a very process of kind of creating the teams and collecting a lot of information on why we choose these teams, and not just like they were a good match because they were there and we kind of matched them together, but like really kind of explaining why these teams match well together. I think that from a VC perspective, right, that is something I would like to see. Yeah.
Yeah, makes sense. In which rounds do you see first allocations being made towards product certifications? For example, in the defense space, NATO common criteria, ISO, blah, blah, blah. Certification costs alone could be 900K, a significant percentage of the earlier round sizes.
I think that very much depends on the case. So we do have investments in space tech, for example, where obviously certifications are critical to get a product launched into space, right? Because if you don't fulfill any like certifications, no launcher is going to take up the product like onto the launcher, and so you cannot launch into space. So if you cannot launch into space, you cannot sell your product to customer. So you have to fulfill the certification sooner than later, right? I think also like in that sense, 900K, if that is something you need early on to get on track with customers, then you should raise enough money to kind of cover that.
How much harder is it for founders who are fresh out of uni, no PhD, no real work experience except student jobs? Are there things on how to compensate this? Also, just saying that this year's Spin-off Summit headline speaker, Flashbot from ESA Aerospace, he basically was just a master's student in a rocket student project. So yeah, perhaps also something to check out.
Yeah, I think, so I said earlier that around 90% of the deep tech hardware companies at pre-seed had a PhD. I think, so as you said, you don't have to have a PhD, right? At ESA, it was like that. Like he didn't have a PhD or doesn't have a PhD. It's not mandatory. What VCs are like looking at obviously is this technical excellence, and if you have a PhD in a field, so but that's a bit of a different discussion. I think we have an inflation of PhDs. Everybody has a PhD these days. That doesn't need to be a sign of excellence, just having a PhD. But obviously, it is something that you can very easily check, right? If a person has spent a significant time on a research field, has certain publications, generated IP. These are points that can be validated from an external person, such a VC. But I think it's not a mandatory thing.
Then Teodoro asks, what is the role of a seed VC in supporting the build-up of the commercial savviness of a semiconductor startup?
Yeah, I think easy answer is it again depends on the case. More in-depth answer is probably that a good portion of sparring, just being a person where you can bounce ideas and kind of like approaches and what like VCs are. We're not good at many things, but what we do have is we have the benchmarking. So we see a bunch of companies in the space. We see a bunch of semiconductor companies in the space, and we know what they had at a given stage and what they did at a given stage. So we can kind of share some insights from other companies that we see and so on. So that like, hey, when you have to engage with customers, like how should you engage with them? So that is I think one area where we can help, just being a sparring partner and kind of profiting from our benchmarking experience. And the other thing would be introductions to relevant customers. And so that doesn't necessarily improve the commercial savviness of a co-founder, but it like helps building up commercial traction. For example, we like as VCs obviously have connections to the major like venture arms of semiconductor companies and can kind of place our companies there, and they can then kind of refer the companies to maybe relevant people in the space that might help. So that kind of like introductions to network relevant people. So that's one thing, and the other thing is kind of being the sparring partner and profiting from the experience that we have.
One very specific question, but really interesting. How do you see Chinese entrepreneurs to raise money from European VCs in such an environment like geopolitics and also market down? Run any tips?
I think it would not be a top of mind topic for me when I look at a company. It's not like, obviously, like we cannot invest in Chinese companies. So that's the first thing. If it's a European company founded by Chinese researchers, for example, or Chinese engineers, I think for me that would not be a top of mind thing. I think for me it would not be a top of mind thing if it's a German entity and a German company.
So basically, found your company in Europe.
But I could imagine that this you might receive a different answer from different people here.
How can one manage an IP and university relations when boundaries become unclear? Specifically, how can research be conducted within a uni while also launching a startup independently without triggering partial ownership claims from the university?
Yeah, it's a good question. Nobody knows. I think that is a question. Like, unfortunately, this type of like the university spin out transfer process landscape in Germany is very fragmented, meaning that probably at every university you have different problems, or like you have the same problems but at different steps, or you experience them differently. I think the key, like I can just tell you what the key is for investors, right? And then you have to kind of manage the university in a way that you kind of are that you still fit for investors and that there are no red flags. Like if you develop IP at university, you have to have access to that IP, meaning you want to have at least an exclusive license, and you want to have probably the right to buy that IP. I say probably, it's like it depends on the case, but like ideally you have an exclusive license and can kind of like purchase it. That's one thing. And the other thing is you want to minimize the ownership of the university to some degree, and you want to have a fast and efficient process, because a lot of investors, if you're in a fundraise process, a lot of investors cannot commit before the IP is settled. I think that also makes somehow sense, right? That you want to have clarity. Like I said earlier, IP is not so important for me, but obviously you want to have some type of clarity on that situation. And so you want to have a smooth process not give away too much ownership for IP. As I said earlier, it's mostly overrated anyways. It's probably important, but it's not like make or break for your company in most cases, in my opinion. Yeah.
And probably choose your university wisely.
Usually that's already, this decision has been done.
If you're still a master and considering doing a PhD, look at their standard spin-off terms. How important do you estimate sizable public funding or public co-invest for pre-seed seed startup to be to successfully close a round?
Yeah, I think pre-seed, not so much to close a round. Like you can close a pre-seed deep tech round without having substantial public funding. I think at seed, I think it's getting very important. I think the typical, like the most popular instrument, Lena, you mentioned it before, is the EIC accelerator, not just because of the 2.5 million a grant, but also because of the equity option that you have for the next raise, for the potential Series A raise. That is an instrument that we see a lot of, good seed companies getting, and you probably have to apply just, timeline wise, you probably have to apply for that before your seed Series A round, something like this. Like, for example, EIC Accelerator, they actually increased the TRL requirements, meaning that for very early companies, it's more difficult to get it now. That's why we also see mostly seed companies trying to get it. I think you can comfortably raise a private pre-seed round without having too much public funding. Again, depends on the case. Obviously, you cannot build a fusion plant without significant public funding. But then after that, I think public funding becomes very important for deep tech hardware companies.
Jury is asking, what is the percentage of companies which approach you or get approached by you in which you finally invest in pre-seed?
The percentage of company, okay. So I think just from the top of my head, I don't have the specific numbers, but we probably look at, we probably speak to more than 1,000 companies a year. We probably see many more decks than that, but don't approach all of them. And we do around 10-ish investments per year. So that's kind of like less than 1%.
Yeah. Is there a database to connect to commercial co-founders, or do you have any tip on where to look? As well, what would you consider to be a bearable wage for industrial experts to lure them away and into a startup?
Is that also something for the Scout network, Lena?
Yeah, that is actually true. We have like a Scout community of roughly 100 people across Europe, more than 50% with a technical background, but also a lot of, with a commercial background. So check it out on our website. There are actually a lot of people that also want to start a company at some point. I think, network is actually for the first question, definitely a good answer. And the second one,
The second one is, I think that is interesting because you obviously at some point, I don't know if it needs to be pre-seed, but like at some point you want to have more, industry experience on the team. And depending on the case, you might want to have that type of persona sooner than later. But you still, at this point, you're still a small team. You're still a startup, right? You have a very different structure than typical corporates. And the people with industry experience are typically from more corporate-like structures, right? I always like, when we look at hiring for our companies, I always like to look for people who have experience in what we call the fast-paced environment. So either startups, scale-ups who have been with, I don't know, if you're an aerospace company, you want to have a person that has spent 5 years in another aerospace company, right? But obviously, corporates is a bigger talent pool because they have much more employees. And so, but you don't want to have a person that does not fit to your culture, that doesn't fit the startup culture. And so it's very difficult to kind of find people with a corporate background that fit well into this startup structure. Obviously, they usually have comfortable salaries, like a certain level of security, and all of that doesn't gel with the startup world. So I think you have to find people that are very happy taking on the risk of working for a startup, but at the same time happy to also take on the potential upside that comes with working for a startup. So if you're a startup, obviously, like the cash salary that you can pay is probably lower than what a corporate can pay, but you can still incentivize people with stock options. You shouldn't throw them out of the window, obviously, but like I think they can be for the right type of persona, a person that is more risk friendly, let's say, you can actually make this very attractive using stock options. But it has to be a culture fit.
And one tip I also give there always, I really like to start this off with like freelance commitment. That actually gives you a good idea of like, as Max mentioned, like the cultural fit, but also kind of luring them in is often the way through having a consulting contract or a freelance contract. The next question, what deep tech topics, subcategories do you see currently underserved? And I love this question. Where would you like to see more founders built in? One of my favorite questions all time.
Yeah. What excites you, Lena? What do you want to see?
It's always, I mean, you can find kind of answers, a lot of answers also on our website under each person profile. You will find a wish list for each First Momentum team member. So that's already a good go-to place. But yeah, I think it's this question of where would we like to see something. Well, personally, me, I mean, yeah, everyone knows this. I have a high passion for architecture. So I'm always in like free printing architecture. What would be the future of, I don't know, building houses in a more sustainable and quicker way? If someone is building something in that space, let me know.
I think I would go with, it's maybe a bit like, because we spoke earlier today in the team, we spoke about aerospace, and we said that, so it's an interesting space, right? We obviously, like, we have invested in ISP Tech, and I have looked at a bunch of other space companies, but I think it's a space that is very present in kind of like public discussion, but at the same time, we don't see many very cool companies in that space. And I think it's a space where you have a lot of, like, if we look into the future a little bit and say, okay, let's assume Starship is really launching regularly and launch costs are dropping 100x, and you have obviously you have ESA Aerospace, micro launches, and you have kind of also a Blue Orbit, and you have a bunch of like other heavy launches and micro launches, and so launch costs are coming down and access to space, it becomes much more easy. So my assumption is that we would see significantly more space companies in the future. I think it's a space I like a lot, just personal interest. We look at it, do see an interesting company from time to time, but we don't have that high volume of really cool companies yet. And I think actually in the past it was a problem because you need a lot of money to fly into space, but now it becomes quite cheap to get into space. So it's actually something that, like much more people can build aerospace companies these days, and probably in the future even more so, just because access to space is so much cheaper.
For the equity story in a seed round, how would you balance mid-long-term platform potential and the first big focus area?
I'm not sure if I understand the question correctly. Um, how would you balance, like, for the equity story in the seed round? I think so. On the equity side, so like what investors are looking at is kind of, okay, how much equity does the company actually need to be successful? Like, after the seed round, how many more rounds do you need? Do you need a Series A? How does a Series A need to look like? Do you need to raise a 10, 15 million Series A? Do you need a 30 million Series A? What comes after that? So investors try to understand the story, because obviously that has an impact on how much they dilute and how much the founders dilute. And we always need to make sure that the founders are incentivized and have a good share of ownership in the company as much as possible for as long as possible. So you don't want to give away too many shares. We also have a small section on that in the Napkin report in terms of like ownership, what we kind of recommend. So yeah, I think that's something you have to balance. I don't know if I understand the mid to long term platform potential really, to be honest.
If you want to clarify, I also put it again as a question in the chat. The ones we don't manage to answer today, we will also answer them asynchronously and then share it with all of you via email. So yeah, put them in the chat. Admin, I love admin. When assessing early stage deep tech startups, which technical, strategic, and team related factors do you consider most critical in driving your investment decision?
I think, I mean, it's a very like open, big question. I think team related, so I mean, pre-seed, so I'm speaking for pre-seed investments, right? team is number one priority. It's probably like 90% of our investment decision. We want to invest in people that have a very high level of technical excellence, where we say, okay, these are among the very few people in Europe or in the world who can build something like this. At the same time, we want to see a very high level of ambition and craziness, probably, because you need to be crazy to want to build a successful deep tech hardware company. And what we spoke about before is the level of commercial savviness. So I think if you kind of combine like ultra high ambition, you commercial savviness basically meaning you already understand your customers, you have a good idea who you're selling to, how sales look like, how you get to a customer, and so on. If you have this good idea at an early stage and technical excellence, 90% of the deal is done, basically. And then, yeah, I think the rest of the rest 10% is then basically, okay, do we understand actually the go-to market? Do we like, there has to be a huge market opportunity, obviously. That's kind of a boundary condition. That's a given. If there's no huge market opportunity, we cannot invest in. And then the rest is kind of like how strong is the technical foundation, and kind of like how far are they in the terms of technical development.
So, but you basically also saying like a team trumps technology in that sense.
Yeah, I think so, yes.
Yeah. How do VCs assess the technical feasibility of the startup? For example, fusion is still a debated topic in academia, let alone in the free market.
Yeah, I mean, fusion is a very special topic. It's probably, yeah, it's not the best way or like the best example, because I agree it's heavily debated and there are tons of challenges, and also it doesn't fit to the typical VC fund lifetimes anyways. So it's kind of a special case. Technical feasibility, obviously. So early stage, what we don't do is we don't go into extreme patent details and kind of, hire a patent lawyer who does a FTO analysis and kind of, analyze it. We don't do that. What we do is we do lots of reference calls with people in the space, with people in the industry, with people from your, meaning the founders, environment. We speak to ex-colleagues, maybe even the professor, trying to get a feeling for, the level of tech novelty and uniqueness. We also look at papers, white papers, and kind of dive actually really, really deep. I mean, we have a very technical team, so we can do that. We do very little with external advisors and do more, our own due diligence plus references.
Have you found any non-obvious or surprising insights in the space of climate tech or carbon capture tech?
I wouldn't say like non-surprising insights. I think like I would say investment priorities have changed slightly, right? So climate tech was a very big topic, and everybody wants, like, climate tech is still a big topic and still interesting, but there's less momentum in that space in general. We see smaller rounds, less capital being deployed. I think some companies that were very hyped a few years ago, I don't want to say struggle now, but like it's just, it's difficult to build a successful climate hardware company. And so momentum has reduced a little bit.
Yeah. Christopher is asking, from your perspective, what are the most effective de-risking strategies early stage startups can adopt on the tech and business side that give VCs the confidence to invest?
Yeah, I mean, it's a good question. It's also something that you can discuss about for a long time. I think on the tech side, it's very hard, obviously, for us. Like, if it's a very technical topic, it's very hard for us to estimate, hey, can they do it, right? In the end, we have to develop a certain trust in the founders that they can actually hit their technical milestones. I think what I always like to see is a good kind of idea of the roadmap, like a tech roadmap that is very ambitious, that is high paced, and at the same time that is kind of reasonable in a way that, okay, if you hit these milestones, you unlock significantly more funding towards your main goal. What I like, the kind of thought process that I usually have is kind of, I try to reverse engineer these type of milestones. I mean, to build the roadmap, you first need to know, okay, where are we? Where do we want to go? And then, okay, how can we, like, what is the last step? Like, how much money do I need for the last step? Okay, that is so much money. Like, I don't know, I need 100 million to build my gold diamond producing facility, and nobody's giving me 100 million for that. So what do I need to unlock 100 million? And then I go back, okay, what is the milestone that comes before that? And how much money do I need for that? And it's maybe 20 million, and it's still a lot of money. How much money what do I need to achieve? Which milestone do I need to hit to unlock these 20 million? And then I go one step back. And so you can reverse engineer the milestones on the way to your goal. Obviously, this roadmap is dynamic, it can change, it can be adapted, but having an idea, I think, is very helpful. On the customer side, I think probably that's a general rule, but it doesn't matter what you build, you want to get in contact with the relevant customers, potential customers, ASAP. And what we are looking for is we are looking for referenceable customer interest, right? If we want to understand, because when we invest in deep tech companies, we take on a lot of tech risk, and there's always uncertainty. Can the tech work? In exchange, we ideally have a case that has very little market risk, so that we know, okay, if the tech works, they can unlock a huge market opportunity. But that means we need to understand that there is customer demand, right? So we want to be in a position where we can speak to these potential customers and they say, yeah, that's exactly what I need. And so we are looking for this referenceable customer interest or customer demand. And building up something like this, I think, even in early stages, is very helpful.
Oliver is asking, any evidence in your data sets that would suggest a bias introduced by impact funds activity? For example, if impact fund activity was eliminated, would the data set look materially different?
Yeah, I think that's not possible to say from the data set that we have, because we didn't ask the VCs to specify if, their impact fund or not. Also, the contributions are made anonymously. I mean, we know who contributed how much, but we don't know which data point was contributed by which investor, and if that investor was an impact fund or not. So can't really say anything.
Yeah, anonymized data. You mentioned the importance of commercial traction and savviness. We're building industrial scale microgravity infrastructure for manufacturing. Potential clients are struggling with imagining their manufacturing in space. Any suggestions as to how to educate customers and gain commercial traction early?
Yeah, it's a good question. I think it's a very interesting space. I mean, we've also looked at a few companies in that space. For us, the question was exactly like, okay, what is because we assume that access to space will be significantly cheaper, and manufacturing in microgravity advantages for certain applications, but it's like what we are still missing is kind of, okay, who is going to buy, how much, what type of products are being produced in space. So there's a little bit of uncertainty there, and I think that's a good question. I don't have an immediate answer, but I think for most VCs this is a very relevant point where they would like to see much more motion, much more demand on the customer side. I think this is mostly solved by really identifying, reaching out to many potential interesting customers, but then kind of narrowing the funnel and kind of focusing on very specific customers where you think you have the highest chance of hitting it, and then really going in depth with these type of customers and see if they kind of respond to that. And if not, you break it up and you move to the next one. That would be kind of a suggestion, but I don't have a answer.
Yeah, I also thought immediately user research, a lot of user research. Ask you, what are the biggest weaknesses you encounter in pre-seed founding teams? What do you expect to see in those teams?
Yeah, I think the most common weakness is a strong level of tech excellence and no to very little commercial savviness. Just because it's I mean, I know it. I was I'm a physicist as well. I've been there. Know a lot of people in academia. It's not something. If you're at university and you build your tech, it's the commercial aspects is usually not something you spend a lot of time on, and then you automatically have just less thoughts on that side, and probably nobody is giving you the feedback at university. At least for me, it was like that. Nobody it was giving me the feedback to change that and kind of like, think about more commercial aspects. And so I think you have to break out of this very quickly. And if you want to spin out a company, obviously, if not, then not. And I think for most companies, this comes not before they approach VCs, and then you speak to them and then you see, okay, they actually have never thought in depth or in the depth that we're looking for about these type of topics. So I think that's kind of like the biggest issue.
We're getting close to the end. So if you have a question, put them into the chat and we'll get or tackle it later asynchronously. Dylan is asking, do you have insights on the return multiple requirements from investors in different stages?
Yeah, so that is very different across the stages and also depends on the space, actually. So obviously for us, we are looking for, like for us, every investment has to be a potential fund returner. We have a 35 million euro fund. If you do the math, we have a certain ownership target. If you do the math, each company needs to reach a billion or multi-billion euro valuation. And from the typical, pre-seed valuations, you're then at around 100x, let's say. So that's kind of like what we're looking for. Massive, crazy returns, obviously, knowing that most of the startups that we invest in will unfortunately not make it. At later stages, it's a very different game. So if you speak to Series A, Series B investors, they are looking much more for, I don't know, returns on the order of 4 to 6, 7x, depending on the fund, depending on the fund model, depending on the space. If you're talking to semiconductor investors, for example, at Series A, they're looking at let's say 3x is a good return for a semicon is Series A investor. It's a different game in that sense.
Yeah, I would say that was the last question. We will answer everything else because there are really a lot still open. And then for email, final question, Max, what would you suggest if someone is a hardware founder raising around? What would be like, your number one tip?
I think the number one tip is that we're looking for crazy ambitious founders, and crazy ambitious founders have crazy ambitious funding plans. That means if you need a lot of dollars to move very, very quickly to reach the next milestone, you should raise a lot of dollars. You should not say, okay, it's a bit difficult in the current environment and economy, and maybe I raise a little bit less now to be on the safe side. I think you want to raise as much as you can to move as fast as you can. And yeah, that's probably my number one advice.
And then run.
And then, yeah.
Thanks everyone for joining the webinar. Also me, I enjoyed it a lot. Thank you all for joining in. Thanks, Max, for your time. And if you haven't done so, download the napkin. You find the link on our website as well. And yeah, as I said, you'll hear from us with all the other answers. Thank you so much. And yeah, see you soon.